In this video, I'm going to show you how I earn monthly rent using my stock portfolio. A few years ago, I heard about this concept that wealthy people don't spend their money on their lifestyle and luxuries. They invest their money into assets, and those assets produce income for them, which can support their lifestyle. I was very fascinated with that concept, but they typically talk about this concept in terms of real estate. Now, I'm not a real estate guy. I don't want to deal with real estate and property taxes and tenants and all of that. I want something that I can do from the comfort of my home on my computer or my phone. So I figured out a way to do this with my stock portfolio. I'm going to teach you the strategy I use to earn 20 to 30K rent in a month from my stock portfolio. I'll show you some real trade examples, and I will also show you how to increase the rental yield and how I get downside protection so I can make money even when the market is flat or even if it market goes down. And I'll also show you my advanced strategy that you have not seen anywhere else, even if you are experienced with options. And this video is for education purpose only. I'm not a financial advisor. I'm going to share some examples from my portfolio, but these are not recommendations. So let's jump into it. This is one of the position in my account on a ticker called TECL. TECL is a leverage ETFs. Leverage ETFs are highly risky. Do your own research and learn about the leverage ETF risk before trading them. My cost basis for these shares was about $20 and my total cost was $83,000. And the total value of this position is now $475,000, which is a total profit of $392,000 on a single position. And the total return is 473% in just 3 years. Now this profit is amazing, but there is something even better. I have accumulated over 4,000 shares of this ETF, and now I can sell monthly covered calls on them and earn this huge rent, which can be about $20,000 to $30,000 in a good month. Here are some of my covered call trade examples. These are just a few of them. I do not have screenshot for every single trade, but you can see these examples. $20,000 profit collected in just 1 month. In this case, I sold 46 covered calls for $33,000 premium. Here, I got $22,000 profit, $21,000 profit, and then collected another $28,000 here, another $25,000 here. So whenever I want, I can go into my account, just click a couple of buttons and sell these covered calls and collect this $20,000 to $30,000. Once I figured out how all this works, I was able to retire from a 6-figure tech job in my 30s by selling options. There is a movement called FIRE, Financial Independence, Retire Early, and I was able to do that in 2022. So I left my job and focused on selling options. Now I don't need to ever rely on a 9 to 5 job. I pay for all my bills, lifestyles, luxuries, vacations using these option selling strategies. About 1 year ago, I got my dream car, which is a Porsche, and I was able to do this by just making a single trade. Even though I can pay 6 figures cash for it, but instead of spending my own money, I just went ahead and sold a covered call on my ETFs and collected $33,000 in premium. Now that $33,000 is more than enough for me to cover all the expenses for this car for 18 months, including all the payments, maintenance, insurance, gas, and everything. Here is how it works. So I have about 4,000 shares of this ETF. Right now, the price is around $118. So if I were to go out and sell a 120 strike covered call, I can get about $815 premium for it, for just 4 weeks duration. Now, since I have 4,000 shares, I can sell 40 covered calls on it. And to sell 40 covered calls, I'm going to get $32,000 premium for it. And if the stock stays under 120, I get to keep that premium. If the stock goes over 120, I still get to keep that premium, but my shares would be sold at 120 price. It basically works like this. We start by buying 100 shares of a stock. Let's say that stock is trading at $50. So our total cost is going to be about $5,000. And then let's say if the stock goes up to $56, that means our stock is in $600 profit. And at that point, we can sell a covered call at 60 strike and collect something like $700 credit. When we do that, we are going to get that $700 instantly in our account, and that is ours to keep no matter what. And this will reduce our cost basis to just $43. So that means from there on, even if the stock comes down, we can still be in profit. And there are going to be two scenarios from there. Let's say the stock is under 60 at expiration. Maybe it goes up a little, maybe it stays flat, or maybe even if it comes down. At that point, I'm going to keep my 100 shares and I get to keep the extra $700 credit I received. And then I can rinse and repeat and sell another call for the next month. And maybe I can get another $500 to $700 credit for it. But if the stock lands over 60 at the expiration, then my shares will be sold at the price of $60 to the other party. But in this case, I still get to keep my extra $700. Since I was able to reduce my cost basis at 43, and now these shares are being sold at $60. That means I would make a total profit of $1,700, which is a 40% return on my $43 cost basis. Take a look at this example. Let's say I bought 100 shares of iron stock at $50 price when it was trading around $50 just a few days ago. And now it has gone up to 56. Now, if I want to sell a covered call, I can go out by 1 month and then I can sell a 60 strike call, which is about 4 points above from the current price. And to sell this call, I'm going to get $702 credit, which means my cost basis was initially 50. With this $700 credit, my cost basis will be reduced to just 43. So I'm going to go here and change my cost basis here to 50. And now if you see here that if the price remains flat, right? Let's say by expiration, even if the price stays flat, I'm going to make $1,373 net profit. If the price goes slightly higher, if it goes to 60, even in that case, I'm going to make $1,700 profit. Let's say now, even if the price comes back down, if price comes back down to 50, which was my entry price, at that point, even though the price has come down 10% from now, I would still make $753 profit. This does not only gives me an extra income, this also reduces my cost basis and my risk. But the downside of this strategy is that if the stock goes up, let's say the stock goes up another 20-30%, it goes to $70. In that case, I'm going to make $1,700. That is going to be my max cap, because anything over $60, I won't be able to capture it because my shares will be exercised at the cost of 60. So that way, there is a pretty good shot of me making $1,700, and I would be happy with that kind of return. If in 1 month I can make $1,700 profit, which is about 40% return, I would be delighted to do that. Now, the iron example have very lucrative premiums because it is a high IV stocks. You'll see that high volatility stocks typically have high premiums like this. But if I wanted to go into something large cap, let's say Meta. So I bought a lot of shares for Meta around $600 to $610 cost basis over the last couple of months. And now this stock has gone up to $660. So I'm almost 10% up on my buys. And now if I wanted to rent it out and sell a covered call to collect premium, so I can do something like this. I can sell 700 strike covered call out of the money. This is trading at 34 delta. So for this, I can get $1,700 premium. And since my cost basis is around $604, so in that case, even if the stock stays flat from where it is now, I'm going to make $7,200 total profit. If the stock goes up to $700, which is my strike price, I will make $11,300. So the maximum profit I can make in this trade is 11,300. So because my cost basis was close to 600. Now, since my cost basis was close to 600, if I make 19% return in a month or two, I would be excited with that kind of return. But even if it stays flat, I'm still going to make 12%. Now, if the stock comes back down to 604 price range, even at that point, I'm going to be still in about 3% profit. So this is not only increasing my profitability, it is also reducing my risk. When selling covered calls, there are two things you'll need to decide: the strike where you want to sell and the date selection. Now, typically when I want to sell covered calls, I go for at least 1 month or longer expiration. 1 month is the bare minimum I want to deal with. I can even go out and sell 3 months expiration, 6 months, or even 1 year. Now, if your goal is to maximize the premium yield, then you can select 50 delta. So let's say if I want to maximize my yield on Meta, I can sell 660 strike, which is close to 50 delta. And for this, I will receive higher premium. I will receive $3,200 premium just for 1 month. And in that case, even if the stock stays flat from where it is now, I will make about 15% return. That is amazing. And this will also reduce my cost basis to 571. Now, I bought these shares at 604, but in this case, I will be able to reduce my cost basis significantly below that to 571. So this not only adds a layer of extra income, but it can also reduce my cost basis and my risk. Now, I have about 500 shares for this. So if I want to sell 5 covered calls, in that case, I can increase my quantity to -5. For this, I'm going to receive $16,000 in premium just for 1 month. So if your goal is to maximize the premium yield and downside protection, then go with 50 delta. But if you want to maximize the stock upside and you don't want to sell your shares, then you can do 20 delta. And in that case, you get to keep the premium and the shares and then rinse and repeat. If you want something in the middle that offers a good balance of high yield and you are okay in case the shares are called away or willing to make some adjustments into your trade, then my choice is typically going to be about 30 delta. You can use this strategy to reduce your cost basis and earn a premium even when you're buying new shares. And let's say, for example, I want to buy 100 shares of Hood. Right now it's trading at $107. So let's say I want to buy these 100 shares right now, and I want to sell a covered call for 1 month expiration at 120 strike. Now, when I do that, even though I am paying about $10,700 to buy shares, I'm going to instantly get $355 credit for it, which is going to reduce my cost basis to $10,344 for 100 shares. That means my cost basis for the shares and my break-even point is going to be $103. If you want to be more aggressive, then I can even move this to 110. In this case, I'm going to receive $677. And in this case, my cost basis is going to come down to $100. So when I make this trade in a single transaction, I will buy 100 shares and I will sell a covered call bundled into a single transaction. In that case, the total amount I will have to pay is not going to be $10,700. It's going to be $10,021 because the credit I'm receiving is going to be upfront and it is going to be instantly subtracted from the cost basis. Now I'm going to tell you my unique strategy that you have probably not seen anywhere else. So I've bought a lot of Robinhood shares over the last couple of months. And when I build a position like this, I'm not selling monthly covered calls on them. So what I like to do is whenever I'm building a new position, instead of selling monthly covered calls, I'm going to go out and sell 1 year expiration covered call. So now let's say if I buy 100 shares of Robinhood for $10,700 and I sell a 120 covered call expiring in 1 year in the same transaction, I'm going to receive $2,217 credit immediately, which is going to reduce my total cost to just $8,481. So basically, I'm getting 21% discount upfront while making this transaction. And in this case, my maximum upside is going to be about 41% because after 1 year, if in January, if the stock is over 120, I will have to sell it at 120. But since my cost basis right now is $84, and if I sell it at 120, my profit at that point is going to be $3,518, and which is a 41% return. So if I make this trade now, just set and forget it for 1 year, and I make 41% return, that is an amazing return for me. S&P makes 10% a year. And here I'm making 41% return without having to do day trade. Don't even have to look at chart or do any technical analysis. If I like this stock, I can make this transaction and add a big chunk of downside protection, because now in this case, even if the stock goes down, my cost basis is going to be about $84. In a worst case scenario, I will have 100 shares of the stock at $84. If you saw in the first screenshot, I showed you that my cost basis for TECL shares was $20. That is exactly how I was able to reduce my cost basis by so much. Over the last few years, I've made a lot of trades like this and made over $1 million in total profit. And so far, I have not lost a single trade like this because I have so much downside protection and so much runway, which is working in my favor. So if the stock goes up, I make 41%. If my stock goes down, I get to buy these shares at a big discount it is a win-win for me in either way. If you want to increase your upside, then I can move this covered call to 150 strike. In this case, I will have bigger upside, which is 62%. And now in this case, my downside protection has reduced a bit. My cost basis is going to be $92. Now to open this trade, my net cost is going to be $9,271, which is also a really good return in my opinion, right? If you are getting Robinhood shares for anything $100, I think this can be a good buy for me personally. I would like to buy and hold this for the next few years, because if I make a trade like this, the worst case scenario for me is I get to buy these shares for $84 and I can hold them for 2 years, 4 years, maybe even 10 years. At some point, it is going to be in profit. Now, a lot of people will say, oh, 41% is nothing. You're capping your upside and this and that. This stock is going to the moon. But realistically, let me show you another example. I made this trade about 1 year ago on IBIT ETF. At that point, people were saying that BTC is going to the moon. It's going to $1 million. Where it is now, it has basically gone nowhere. If we are looking at this 1 year chart, you can see that IBIT is basically down 15% over the last 1 year. And when I make this trade, IBIT was trading at $54. So my cost basis was around $54. And at that point, I sold a 54 strike covered call for it. And I collected about $1,700 in premium. And this covered call expired on January 16th, just a few cents above 54 strike. And my shares were sold at 54. And now IBIT is trading at $50. So basically, I ended up making about $16,080, which is 45% return in 1 year, while this ETF actually went down 15%. So in this trade, I was able to make 45% profit even when IBIT went down. If you were just buying this outright, it would need to go to $80 for me to be able to make 45% return, and it never went anything close to that. And the great thing is that when I entered my trade, soon after that, it actually came down very sharply. And even during this time, there was actually no drawdown in my trade. My trade was always green while it did its thing. It went up, it went down. My trade was green throughout and it closed at 45% profit. And I did not even have to do anything. It was automatically closed because I actually forgot about it. I was thinking of closing my covered call for a few cents before the expiration. But since the price actually went above 54 on the expiration day, this was automatically closed. And it kind of worked in my favor because it came down after that. Let's look at a couple more examples. Let's say if I want to make another trade like this on TQQQ, which is also a leverage ETF, I can buy 100 shares at about $54 and immediately sell a strike covered call, and I will receive 1,238 premium for it, which is going to bring my cost basis down to $42. So that means even if this ETF goes down 23%, I'm still going to break even. If it stays flat, I'm going to make 31%. If it goes up, I'm still going to make 31%. Now, if you feel that, hey, no, this can actually go up 100%. Just to remind you, the CAGR for this ETF over the last 5 years is about 19%. And for the last 10 years, it's about 36%. And if I'm getting a setup like this, where I can make 31% return, with lower volatility than just buying the shares outright, it is a win for me. And typically I like to make these trades when the stock is in a pullback. In those scenarios, the IV is usually higher, and this yield can be somewhere between 40 to 50% in that case. Now, let's say if I want to do something which is very high volatility. Micron had a big run over the last few months. It is at $400. A lot of people are saying that it is still undervalued. It can go higher. But since it has had a big run, it's up to 87% for the year. Now, I don't expect it to go another 200, 300% over the next year, but it can still do very well. If I am feeling FOMO and I really want to get into this, I can use this strategy and it can work out really well, even though the stock is at all-time highs. So if I buy 100 shares, which is close to $400 right now, and I immediately sell 400 strike covered call, I can get 41% yield in just 1 year. So in this case, I will also get a lot of downside protection. The downside protection is minus 29%. So now if the stock pulls back and comes down, I will have a short at these shares for 283. That is going to be my cost basis. But if I want to increase my upside, I can move this to 450 strike. In this case, I'm getting $9,900 premium and my break even is going to be about $300. which is minus 25% downside protection with 50% upside. Now, what if the stock crashes? What if this goes down 50%? If you were to buy just 100 shares and it goes down 50%, you will lose 50%. But if I'm using this strategy, if it goes down 50%, my loss is only going to be 30%. And that's temporary, because in that case, my cost basis is now 283. I can hold it and I just need it to come back to over 280 to break even and get back in green. So my recovery is going to be so much faster. If you feel that 40 to 50% return is nothing for you, just to let you know that Warren Buffett, who is the world's greatest investors, makes close to 20% a year. And the world's greatest quant funds, which turned a few $1,000,000 into billions of dollars, they make about 40% return in a year. So here I'm getting 41% return with 30% downside protection just for a set and forget trade. It does not require any fancy analysis. How to get the best results using this strategy? So first of all, only buy stocks and ETFs which you want to own. Don't just chase the high yield. You actually have to like the stock. Only buy stocks which you are comfortable owning and holding for the long term. And you need to decide if your goal is to maximize the upside or the yield. So if your goal is to maximize the upside, then sell 20 delta covered calls. If your goal is to maximize the yield, then sell 50 delta, or you can pick somewhere in between about 30 to 35 delta. Now, I don't sell covered calls every month. I like to wait for opportunities when the stock is overextended and I'm expecting a pullback. After a stock has had a big run and it's at a resistance level, and now I think that it is going to pull back. In that case, I'm going to sell a covered call between 40 to 50 delta with 1 month or longer expiration. And when the stock comes back down, I can buy my covered call back for pennies. Let's say I sell 40 covered calls for TECL and collect about 30,000 in premium, and market pulls back a couple of percentage over the next month. In that case, my covered calls are going to lose 80% of their value, and I'm going to close it at 70 to 80% profit and capture most of the yield. But in case the price runs up above my strike price and I don't want to sell the stock, then I can roll my covered call up and out to the next month. So basically, I can roll it out to the next month and increase my strike price to a point where I'm able to do that for around break even. In that case, I can continue to roll it month after month until I see an eventual pullback. In that case, I'm going to close my covered call. This strategy is very effective and powerful, but it is the tip of the iceberg. There are some more advanced strategies that I use to increase my upside and protect my downside. And I teach them in my coaching program. So in my coaching program, I teach you my full 5-part system where you learn how to find profitable opportunities, how to find entry and exits, and how I deploy different option strategies, how to manage those different option strategies, adjustment and rolling strategies, and profit taking and risk management. So if you want to get this complete system, you can check out the description below.